Hi and welcome to this week's Property Insider video. Today Dr. Andrew Wilson and I go through a number of good news items that have only come up over the last week that's going to give us an indication of what's ahead for our property markets. One of the interesting factors is that investors are back into the market, but in one particular state, and when you hear our breakdown, you'll find out which state that's in. And we're also going to talk about the latest economic figures, home loan figures, jobs figures, and building approval figures. All this is going to give you a good idea of what's happening in our property markets. And if you want to keep up to date with us each week, just subscribe to our YouTube channel and click the little bell icon so we keep you up to date each time a new show comes out. I took some time over the weekend to look at some articles and some commentary that came out just a year ago when the great virus crisis was just beginning. At that time, the media was full of negative commentary. But during those times, in these weekly Property Insider videos, Dr. Andrew Wilson and I gave measured commentary. We gave a perspective gained from years of experience in the market. But we were circled by a pack of hangry housing bears. They were confidently growling that the local house markets were going to slump by the largest margin on record. Of course, they were fueled by some crazy forecasts from the banks and the perennial negative Perma Bears, the people that are always negative. They were praying for the mother of all housing depressions. Well, look what's happened now. The media's full of positive news, and most of those bears have hidden back in their caves. I guess they're hibernating for the next time round. But some are still out there. Some are still telling us the upturn in our property market's temporary. Well, as I said, there's so much good news in the media at the moment. I don't think we can cover it all, not even all that's happened last week. But I'm looking forward to my weekly chat with Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market. Hi, Andrew.
Yes, hello, Michael, and what a difference a year makes. I think we say that just about every week, but we've had some data out this week which really has turned the market in terms of house price growth on its head, given what the general conversation was a year ago.
Very much so. Well, people were talking about a mortgage cliff. They also talked about a JobKeeper cliff. But let's start with the mortgages. Remember how the pessimists were worried we were going to fall off a cliff due to all those deferred home loans? Now, for those who don't remember, I don't know how you couldn't, many of the banks gave temporary relief. They gave it to borrowers who were impacted by COVID and allowed them to defer payments for a period of time. But Andrew, more recently, APRA has said that the number of home loans that are deferred, that are not being repaid, is dropping consistently month after month. In fact, it's only 1.4% of total loans outstanding.
Yes, Michael, and of course, again, it reinforces what the event, last year's event was, and it was an interruption to our normal operation in terms of housing market supply and demand. And once that interruption was, fixed, and that is the shutdown, the coronavirus shutdowns, we were back off and running again. And it was it's been those interruptions to the market over the past 3 or 4 years that have interfered with the orderly function of house price growth particularly. And we're certainly still in catch-up mode now, and we're seeing some extraordinary results. We're now just really finding the levels of supply and demand that we were unable to put into the marketplace because of those various interruptions, and the main one, of course, over the last 12 months was the COVID lockdowns.
Well, we know that some homeowners and some property investors took advantage of the safety net. They didn't use those deferred home loans. They didn't spend the money. So now they're repaying it. But the other cliff people thought would be falling off was the jobs cliff. But recently, more jobs have been created, and the latest job vacancy data suggests that that's not going to be a real issue either, Andrew.
No, Michael, and I guess there's a real crisis in credibility from those that have been picking up that narrative over the last 6 months. Yes, JobKeeper was good. It was helping keep the economy afloat, but wait till it finishes. It will fall off a cliff. Unemployment will skyrocket. That commentary is now fading into the background clearly. And with an unemployment rate now with a 5 in front of it, and we did predict this, but it's come a little earlier than even we predicted, Michael. But certainly there'll be an impact with the end of JobKeeper. But the loss of support that will equate to higher numbers of jobless will be offset by what's been a massive increase in job creation over the last 6 months. And that's likely to continue, Michael. I think that we'll still be able to maintain an unemployment rate with around about a 5 in front of it. Yeah, look, it's been a tough gig for those that have made those predictions, and it's a salient point. Dare I say, fake property news has been alive and well for the last few years, but this is the big reality check that those headline chasers have now got to face. And I suppose those that are really most are confronted by this are the various media that promote these particular nonsense doomsayer mantras, and they've got to understand that their audience must be looking at them also with some question marks, given how heavily they promoted the doom and gloom last year. And if you're making a decision in terms of property, whether it's as an investor or an owner occupier, I guess you've got to think very carefully about where you're getting information from now, because if you had followed that, you would have been in deep trouble, Michael.
Very true. Now, one of the other incentives was the home builder incentive to help the building industry. It
Yes.
wasn't really to help first homeowners, and it's actually worked. Building approvals have leapt again. In particular, it's for single dwellings, for detached dwellings, not for apartments, as we've said before. And even though home builders phased out, it's actually going to leave a real long pipeline of work. So that's another area where jobs have been created, but it's also good for our economy with the spin-off effect when first home buyers move into their new homes.
Yes, Michael, it's been obviously a positive policy, the home builder initiative from the federal government. We've, of course, are now past that. That ended on the 31st of March. It was a second smaller grant that was offered as an extension. And we're still, of course, seeing building approvals rise because there is a lag between the signing of the contracts and the actual approved homes being approved. On an annualised rate, the latest data, of course, shows another increase, as I said, because of those lags. But we're still below where we were on an annualised basis I think we'll exceed that 3 years ago. But when we look, as you mentioned, Michael, at the overall approval of dwellings, that includes units, we're actually still 50,000 units on an annualised basis to the year ending February, below where we were at the peak in 2017. Almost, not quite, but unit approvals are falling nearly as rapidly as house approvals are rising. So we need to have, a big picture look at the overall supply of homes in Australia, and that continues to fall in terms of overall numbers of dwellings, inclusive of houses and units, although houses are certainly steaming along. And I thought, Michael, it's just interesting when we look at the state breakdowns, which I think are certainly incisive, because there's no doubt that Perth and Western Australia are having a massive home building boom at the moment, house building boom, of course. In fact, when we look both at the building approval numbers and the home loan approvals for newly built homes, Western Australia and Perth are just below now Melbourne. So they've moved into second place, higher than Brisbane, Queensland, and higher than Sydney, New South Wales in terms of approvals for loans for new building and for building approvals for new homes as well. And that will certainly help the Western Australian economy, Michael, as you suggested.
Sure. Well, there is a side effect, though. The rampant demand in renovations and all new building is actually hitting customers with significant delays. The building industry is having difficulty coping. And there's also some disruptions, I hear, Andrew, from the international supply chains. It's only making matters worse. I guess what this means is this is also going to push up the cost of new construction, and that'll actually increase the CPI, something the government's wanting, the Reserve Bank's wanting to increase our inflation, because there is quite some weighting on the housing in that basket that the Reserve Bank uses for CPI measurement.
Well, we're bringing forward demand here, Michael, and we know that there are significant temporal imbalances between supply and demand. You just can't sort of decide to buy a house and then add water and there it is. And when you get these extraordinary increases in demand for new housing, of course, the industry is going to have some difficulty coming off a low base in matching the demand. Just as we'll see at the other end of that, when we do see all these homes or houses built, there will be a lack of demand actually get moving forward because we have brought so much demand forward. And building costs are higher. That means that those that are coming in afterwards that don't have the advantage of that home builder grant will have to pay more for their new homes. So it's swings and roundabouts. The whole point is that we have needed to see this stimulus to the economy. It's been provided. And I guess the challenges that come after that, that'll be another question of government policy positions.
Well, we've seen that in the past when there have been first homeowner grants bringing forward demand. There was a lull afterwards. In the past, though, it sometimes created a boom in the existing home market, the established home market, because first homeowners were getting grants for those sort of properties as well. We called it an existing homeowners grant as well, jokingly, but that's not the case this time. They're really looking for new homes, and that's boosting our building approvals. It's also created a boost in loans. So most recently, the loan data, while it fell a little bit in February, but that was after a big high in January, it actually showed that homeowners are obviously very active in the market, but investors are starting to come into the market as well, Andrew.
Yes, look, I guess we could call it a consolidation in terms of owner-occupier lending was revealed over February. We had a slight falling away of owner-occupiers with trade-ins and a slight falling away of first home buyers. Of course, they don't have trade-ins. But as you said, Michael, from a very high level, I think that we'll pick that up again because we know the housing market's been very strong into March. We know those forward indicators are extremely strong in terms of demand, auction clearance rates particularly. So I would suggest that those numbers will rise again in March. The investor numbers are interesting, Michael. We did see a pickup in the level of investors, and investor numbers have been rising over the past 3 or 4 months with the market. But when we look at the position of investors against the other buyer types, we can still see that they're underperforming, even though that was the highest value for a couple of years in terms of investor lending. It did, for the first time in a few months, pick up over the value of first home buyer lending. So investor lending is now marginally higher than first home buyer lending, but it has been below that over recent months. And that's quite extraordinary. We've never ever seen that before, where first home buyer lending was higher than owner occupier, than investor lending. And when we look at the market share has risen for investors. It's now over 20% of total residential lending, but last month it was the lowest level on record at 19.2%. So it's still very low because we've got to understand that the long-term average market share for investors compared to total residential lending is 33%, Michael, and now it's just at 20%. And this is in an environment of very strong prices growth where you would expect to not only see more investors in the market, but also be seeing investors pushing up prices because of their activity. Now, that's not happening, and that's why our regulators will be sitting on their hands through this cycle because of still low numbers of investors. But again, when we look at the breakdown of the various states, Michael, for investors, we see actually New South Wales fell in terms of investor numbers over the month, but we did see a very, very big increase in Victoria. In fact, it was the increase in Victoria, Michael, that was really responsible for the uptick in investor lending. So looks like Victorian Melbourne investors are very keen to get into the market at the moment, Michael, because that latest data, which showed investor numbers up overall nationally, was really a product of very, very strong growth in Victoria over February.
Well, maybe I got a vested interest, but maybe as Victorian investors are a little bit smarter than the pack. Now, Andrew, you've been saying that property values are surging, but I know you're doing regular research on the rental markets as well and bringing out a monthly rental report. What are you finding happening in our rental markets around Australia?
Well, rents are reasonably steady on a month-to-month basis, Michael, as you would expect. But when we look over the yearly change in rents, we can see still a very significant fall in unit rents in Melbourne and Sydney. They're the really outstanding results. But we're also seeing rents rising for houses in most of our capital city markets. And also vacancy rates are reflecting that. Vacancy rates for houses are continuing to fall, particularly in Brisbane and Perth. Perth's already remarkably turned that market on its market on its head. Its rental market from being the most oversupplied of rental markets to now one of the most undersupplied. But that Brisbane market is really, tenants are struggling to find properties. Even the unit market vacancy rates are falling in Brisbane, and house vacancy rates are falling quite sharply. And I think that reflects what we know is a strong uptick in migration into southeast Queensland. I think that's producing demand ahead of existing supply. But yeah, it's that general picture continuing, Michael, of high vacancy rates for units in Melbourne and Sydney near record levels. No sign of that easing at all, Michael, and lower rents. And I think we've still got some way to go in terms of finding I guess the base in terms of where rents will be in those unit markets. And let's be clear about this. It is in the city apartments, CBD apartments, that are struggling to find tenants, where we have seen the most significant fall in rentals. In some of those suburbs, rents are down nearly 30% over the past year. But I'm thinking, just speaking about the mortgage relief package that the banks have been offering, and we know that owner-occupiers have really moved off those support packages, but we've still got, I guess, the question mark whether we will start to see some impact from investors that have been taking advantage of those various relief packages, not just the mortgage relief packages, but other packages that state governments have been offering to support the rental market, whether that does have some impact on the market in terms of properties coming in for sale.
There's no doubt that some of the investors in those inner city high-rise apartment towers are suffering lower rents and lower values. Some of them are going to be stuck, Andrew, because with the lower values today, not many people interested in buying used apartments in those towers. They're actually going to have difficulty paying off their mortgages. Puts them in an awkward position financially.
Yes, Michael, but I do think that we will see an adjustment coming through, because there's still reasonable appetite from owner-occupiers for inner-city apartments. I think we'll see at least some of that stock being purchased by particularly downsizers and empty nesters looking for an inner-city lifestyle. And you've got to understand, downsizers and empty nesters are really taking advantage, or could take advantage, of what's a bonanza for those middle-ring suburbs, particularly with very strong buying activity. So it's probably a good time to think about that, downsizing into an apartment. You're getting record prices for your old family home, and you can obviously have a lot of choices, particularly if some of that investment stock in the city apartments in Melbourne and Sydney. So that might help to provide some relief for those investors that are perhaps forced to sell, but or are considering selling, and also first-home buyers may be interested in those inner-city apartments once prices come down. But I do think we've still got some way to go in terms of price declines in those particular markets before we start to see an offset from increased demand from those other buyer types I mentioned. So it's not all rosy in the housing market, Michael. There are certainly mostly rosy, but there are some issues that are certainly we can't describe, or some segments we can't describe as a boom market.
Clearly, but that's fine. We've got more green shoots than we have weeds in our garden, so things are going well. I look forward to catching up with you again next week and hearing what other news has happened over the meantime. Thanks, Andrew.
Well, thanks, Michael.